Imagine waking up one morning, checking your bank account, and realizing that your mortgage payment just doubled. Not in 5 years. Not in 10 years. Right now. This is not a hypothetical scenario. This is the reality hitting millions of Canadian families at this very moment, and what's coming next could reshape the entire Canadian economy as we know it. The mortgage renewal crisis sweeping across Canada is being called the worst financial nightmare in a generation, and the numbers behind it are absolutely staggering. If you live in Canada, own a home, or are even thinking about buying one, you need to understand what is happening right now. Before we dive into this, if you find value in content that breaks down complex economic situations and helps you understand what's really going on in the world, make sure to hit that subscribe button and turn on notifications so you never miss an important update. Trust me, you're going to want to stay informed on this one. Let's set the scene. Between 2020 and 2022, Canada experienced one of the most aggressive real estate booms in its entire history. Interest rates were sitting at historic lows, hovering around 1.5 to 2%. Money was essentially free, and Canadians took full advantage. People rushed into the housing market, stretching their budgets to the absolute limit because why not? Monthly payments were manageable, even on homes worth $700,000, $800,000, or $900,000. First-time buyers jumped in, investors scooped up multiple properties, and housing prices skyrocketed by over 50% in just 2 years in many markets. But here's the thing about Canadian mortgages that many people outside the country don't fully understand. Unlike in the United States, where a 30-year fixed mortgage locks in your rate for 3 entire decades, Canadian mortgages typically come with terms of just 5 years. Some people choose variable rates, some go with 3-year terms, but the most popular option by far is the 5-year fixed mortgage. This means that every 5 years, regardless of what's happening in the broader economy, you have to renew your mortgage at whatever the current interest rate happens to be. Now do the math. If you bought a home in 2020, 2021, or even early 2022 with those incredibly low rates, guess what? Your renewal is coming up right now in 2025, and the interest rate environment has completely transformed. The Bank of Canada went on one of the most aggressive rate-hiking campaigns in Canadian history, bringing rates from near zero to over 5% in a remarkably short period. Even after some recent cuts, rates remain dramatically higher than what homeowners locked in just a few years ago. The scale of this problem is difficult to overstate. According to Canada Mortgage and Housing Corporation, approximately 4.2 million mortgage holders are facing renewal between 2024 and 2026. That represents nearly 60% of all outstanding mortgages in the entire country. We're talking about a massive wave of renewals hitting the market all at once, and the financial impact is going to be brutal for millions of families. Let me give you a real-world example to illustrate just how severe this situation is. Picture a young couple who bought their first home in Toronto in 2021 for $900,000. They put down 20%, giving them a mortgage of $720,000. At a rate of 1.8% with a 25-year amortization, their monthly payment was around $2,950. Tight but manageable on their combined household income. Fast forward to their renewal in 2026. Even if rates come down slightly from current levels, they're looking at renewing somewhere in the 4 to 5% range. That same mortgage, now sitting at around $650,000 after paying down some principal, would suddenly come with monthly payments of approximately $3,800 to $4,200. That's an increase of $850 to $1,250 per month, or roughly $10,000 to $15,000 more per year, just to keep the same roof over their heads. Now multiply this scenario by millions of households across Canada, and you begin to see why experts are using words like crisis, catastrophe, and unprecedented to describe what's unfolding. The psychological impact is already becoming visible. Mental health professionals across Canada are reporting a surge in clients dealing with financial anxiety, specifically related to mortgage stress. People are losing sleep. Relationships are straining under the pressure, and the fear of losing their homes is becoming a daily burden for an alarming number of Canadians. This isn't just an economic story. It's a deeply human one affecting real families, real dreams, and real futures. But here's where the story gets even more complicated. Many of these homeowners made other financial decisions based on those low monthly payments. They bought new cars. They took on lines of credit for renovations. They planned their family budgets, their retirement contributions, and their children's education funds around a certain level of housing costs. When your mortgage payment suddenly jumps by $1,000 a month or more, something else has to give. Financial advisors are seeing a disturbing trend emerge. People are raiding their retirement savings to keep up with mortgage payments. They're maxing out credit cards. They're taking on second jobs, cutting back on everything from groceries to health care, and making increasingly desperate financial choices just to stay afloat. The long-term implications of this behavior could affect these families for decades to come. The rental market is feeling the pressure too. Many of the properties purchased during the pandemic boom were investment properties, and the owners are now facing the same renewal shock as primary residence owners. The difference is that many investors plan their numbers based on rental income covering most or all of their mortgage costs. When monthly payments nearly double, the math simply doesn't work anymore. Landlords are left with a difficult choice. They can try to dramatically increase rents to cover their costs, which pushes the burden onto tenants who are already struggling with affordability. They can sell the properties, potentially flooding the market and driving down prices. Or they can continue bleeding money month after month, hoping the situation improves. We're already seeing this play out in markets across Canada. Rental listings have increased significantly in cities like Toronto and Vancouver as over-leveraged investors try to exit their positions. At the same time, rental asking prices have surged as landlords who choose to stay try to pass on their increased costs. Tenants who were already paying historically high rents are now facing even more pressure. And the most vulnerable Canadians are being squeezed from all directions. The broader economic implications are keeping policymakers up at night. Consumer spending in Canada is heavily influenced by housing costs, and when families suddenly have to redirect $1,000 or more per month toward their mortgage, that money doesn't get spent at restaurants, retail stores, or on vacations. Local businesses feel the pinch. Job creation slows. The ripple effects spread throughout the entire economy. Some economists are warning that Canada could be heading toward a consumption-led recession, where the combination of high debt levels and surging housing costs causes families to pull back so dramatically on spending that it triggers broader economic contraction. The Canadian economy has been remarkably resilient in recent years, but many experts believe this mortgage renewal wall represents the biggest test since the 2008 financial crisis. The housing market itself is showing clear signs of stress. Sales volumes have dropped significantly in many major markets. Homes are sitting on the market longer. Prices in some regions have already come down 15 to 25% from their peak levels. While some first-time buyers might see this as a positive development, making homes slightly more affordable, the situation is far more nuanced than it appears. Falling prices create their own set of problems, particularly for recent buyers who now find themselves underwater on their mortgages. If you bought at the peak in 2022 and prices have since dropped 20%, you might now owe more than your home is worth. This makes it impossible to sell without bringing money to the closing table, and it limits your options when renewal time comes. If your lender decides you're too high risk, you might not qualify for the best rates, or in extreme cases, you might face challenges renewing at all. The Bank of Canada is caught in an incredibly difficult position. On one hand, they've been battling inflation and need to maintain credibility on the price stability front. On the other hand, they're acutely aware that millions of Canadian families are about to face severe financial pain. Recent rate cuts have provided some relief, but rates remain substantially higher than the levels homeowners originally locked in at. There's ongoing debate about how much further rates can or should fall, and whether monetary policy alone can solve a problem of this magnitude. The federal government has attempted some interventions. They've extended the maximum amortization period for certain buyers to 30 years, which spreads payments over a longer period and reduces monthly costs. They've introduced some mortgage relief measures and are exploring other options. But critics argue these measures are largely band-aids on a much deeper wound, and some believe they might actually make the problem worse in the long run by encouraging more debt rather than addressing the fundamental affordability crisis. What makes this situation particularly challenging is that there are no easy solutions. If the government aggressively cuts rates to help mortgage holders, it risks reigniting inflation and devaluing the currency. If they provide direct financial assistance to struggling homeowners, it creates moral hazard and raises questions about fairness for those who didn't overextend. If they do nothing, millions of families suffer, consumer spending collapses, and the economy potentially spirals into recession. Some experts are now predicting a wave of forced sales as homeowners simply cannot afford their new payments and have no other options. While this hasn't materialized at scale yet, the leading indicators are concerning. Mortgage arrears and defaults are ticking upward. Consumer insolvency filings are rising. The number of power of sale listings, Canada's equivalent of foreclosure, has increased in several markets. The timing of these renewals is particularly cruel because many of these families did everything they were supposed to do. They saved for down payments. They qualified for their mortgages through proper stress tests. They made their payments on time for years. They didn't do anything wrong. They simply couldn't have predicted that interest rates would rise so dramatically, so quickly, in such a compressed time frame. The stress test that was supposed to protect them assumed rate increases of around 2 percentage points. What actually happened was significantly more severe. There's also a generational dimension to this crisis that deserves attention. Many of the hardest-hit buyers are millennials who stretch to finally get into the housing market after being priced out for years. They're now facing the prospect of losing the homes they worked so hard to afford. potentially setting them back decades financially. The dream of home ownership that defined previous generations is becoming a nightmare for many young Canadians, and the psychological scars from this experience could influence their financial decisions for the rest of their lives. The situation varies significantly by region, which adds another layer of complexity. Markets like Toronto and Vancouver, where prices were already extremely elevated, are seeing the most severe stress. Smaller cities and rural areas have different dynamics, though they're not immune to the broader pressures. Prairie provinces that never saw the same level of price appreciation are experiencing less acute pain, while British Columbia and Ontario are bearing the brunt of the crisis. Real estate professionals are divided on what comes next. Some believe we're heading for a significant price correction, potentially another 10 to 20% decline in the most overheated markets. Others think prices will stabilize at current levels as immigration continues to drive demand and limited supply keeps a floor under values. Almost everyone agrees that the next 18 to 24 months will be critical in determining the trajectory of the Canadian housing market and the broader economy. For homeowners facing renewal, the advice from financial experts is consistent but challenging to implement. They recommend starting the renewal process early, ideally 4 to 6 months before your term ends. They suggest shopping around with multiple lenders rather than simply accepting your current bank's renewal offer. They advise reviewing your overall financial picture and identifying areas where you can reduce expenses before the payment shock hits. And they strongly encourage anyone who's struggling to reach out for help before they fall behind, whether that's a financial advisor, a credit counselor, or their lender directly. Many lenders are aware of the situation and are more willing to work with borrowers than people might expect. Extended amortizations, interest-only payment periods, and other modifications may be available for those who ask. The worst thing someone can do is hide from the problem and hope it goes away, because it won't, and the consequences of inaction are severe. There are some signs of hope on the horizon. Inflation has cooled considerably from its peak levels, giving the Bank of Canada room to continue cutting rates. Some forecasters expect the overnight rate to fall another 100 to 150 basis points over the next 12 to 18 months, which would provide meaningful relief to mortgage holders. The economy has proven more resilient than many pessimists predicted, and the labor market, while softening, remains reasonably strong. Additionally, not everyone who bought during the boom is in trouble. Many buyers had substantial equity, strong incomes, and conservative debt levels. They may face higher payments at renewal, but they can manage the adjustment without significant hardship. The crisis is real and widespread, but it's not universal. Plenty of Canadians will navigate this transition successfully, even if it requires some belt-tightening. The key lessons from this situation should resonate well beyond Canada's borders. The risks of extremely low interest rates, encouraging excessive borrowing, the dangers of treating housing as a guaranteed investment rather than a consumption good, the limitations of stress tests that fail to account for extreme scenarios, and the interconnectedness of housing markets, consumer spending, and overall economic health. Countries around the world that experienced similar low-rate housing booms are watching Canada closely. The United Kingdom, Australia, New Zealand, and others have their own versions of this mortgage time bomb ticking, and how Canada handles the situation could provide a template or a cautionary tale for the rest of the world. What happens next in Canada will be determined by a complex interplay of factors: monetary policy decisions by the Bank of Canada, government interventions and housing policies, global economic conditions affecting immigration and capital flows, and the collective decisions of millions of individual homeowners, each trying to navigate an incredibly challenging situation. For now, the panic is real, the stress is mounting, and millions of Canadians are preparing for what could be the most financially difficult period of their lives. This is not just a housing story or an interest rate story. This is a story about the Canadian dream, about family security, about retirement plans, and about a generation that played by the rules only to find those rules had fundamentally changed. The coming months and years will reveal whether Canada can navigate this crisis without severe economic damage, or whether the mortgage renewal nightmare will leave lasting scars on families and communities across the nation. Either way, this moment represents a turning point for Canadian housing and Canadian household finance, and the decisions being made right now will shape the country's economic future for decades to come. If this video helped you understand what's happening in Canada right now, please hit that like button because it really helps get this information out to more people who need to see it. Drop a comment below sharing your thoughts or your own experience with the Canadian housing market. I read every single comment and love hearing from you. And if you haven't already, make sure to subscribe and turn on notifications so you stay informed on the economic stories that actually matter. Thank you for watching, and I'll see you in the next one.